Good morning. In today's class, let us start with the customs duty. Due to some network issues, it got delayed. So, just for your information, if you compare this attempt with the previous attempts, one difference or one big difference that you could see is that the number of chapters in customs has been reduced significantly. If I recollect, there were around 15 chapters, if not more. Now there are around only 8 chapters. They have reduced the number of chapters significantly on one hand. On the other hand, the weightage as such for the customs as a whole has not been reduced. So from that perspective, with the limited number of chapters, you are getting more marks. So therefore, it is very important that we do not skip any of the areas in customs. Of course, I wouldn't be able to cover everything, but as an advice, I am saying you always prefer study material. Why? Because generally institute does not go beyond study material as far as customs law is concerned, and you anyway have the past questions compilation. So therefore, if you study the study material alone, in my opinion, that should be sufficient. Of course, for objective dates, you have to look for a source. In fact, that is the reason why I am also taking study material as the base, and I have highlighted portions where you have to draw more attention. Because there is no point in cut shorting in customs because already you have only 8 chapters, and from that you are expected, the number of marks expected is around 30, 25 to 30 marks. So in which case it is not advisable to ignore anything. So let us start with chapter 1, levy of customs duty. Let me share the notes. Yes. Let us start with the basic concepts. Now, what I have done is I have highlighted relevant portions which you have to give more emphasis on. Certain things I will tell you, you can completely ignore. For example, if you take this chapter 1, it is divided into 2 parts, unit 1, unit 2. All these basic concepts, unless and until you want to know what is the customs, what is the background, how it came, etc., you can refer it. Otherwise, it is not required. Again, part number 2 is constitutional provisions. Again, you can ignore it. In exam, from exam's perspective, they won't ask anything. Just for your knowledge sake, if at all you want to learn, you can learn. Right? Again, how the customs law is structured is given in this table. What are the chapters in customs law, section numbers, etc. You can have a look at it, but from exam's perspective, definitely not relevant. Right? We can directly come to some important definitions. First definition is India. I think I have not discussed the definition of India under the GST law, but let us try to compare and contrast India definition under the customs law as well and India definition under the GST law. Customs law definition is very, very simple. It says India includes the territorial waters of India. It just stops with that. But if one looks at the definition of GST law, India includes territorial waters, India includes continental shelf, India includes exclusive economic zone. So the definition as such compared to GST law is very, very narrower in customs law. Now the next question is, sir, what is territorial waters? What is continental shelf? What is exclusive economic zone? So, for the sake of understanding, let us assume you know the India map, right? Let us assume in the map all the edges are called as baselines. Just for our simplicity sake, all the edges of the maps are called as baselines, right? That is called as baseline. That line is there, no, that is baseline. From that baseline up to 12 nautical miles. What is a nautical mile? You can Google it. Up to 12 nautical miles, it is called as territorial waters of India. So from the baseline up to 12 nautical miles, it is called as territorial waters of India. Right? Up to 200 nautical miles. From the baseline up to 200 nautical miles, it is called as exclusive economic zone. What is the difference between two? We will not see the difference between two now. Only thing that we will try to understand is India definition extends up to 200 nautical miles under GST law, whereas India for the purpose of customs law restricts itself up to 12 nautical miles. This is the basic understanding which we should have, because as and when the term India is used, you should only assume up to 12 nautical miles. This will be very helpful when you understand chapters like types of duty, etc. Okay. The next definition that could be relevant is Indian customs water. Please understand the term India is different. Indian customs water is different. Different. Indian customs water is also different, which is actually similar to your GST definition. It means the waters extending into the sea up to the limit of exclusive economic zone under section 7 of territorial waters so and so law, and includes any bay, gulf, harbor, creek or tidal river. The first question that should arise in our minds is that why is there different definitions for India and Indian customs water? So there are two things. One, taxability. Second, control. What is control? What is taxability? For the purpose of taxing a transaction, first of all, I think you will be aware that customs law taxes two types of transactions. One, import of goods. Second, export of goods. For the purpose of taxing import or export of goods, the term India is relevant. But for the purpose of controlling what all the ships that can come into India, what are all the activities that a vessel can perform in the sea, etc., this Indian customs water is defined. If you look at the reasoning, if a person has committed any offense punishable under customs law within the Indian customs water, he may be arrested. Which means, though the taxability is only with respect to India, but any activity that you do, customs law will certainly govern you. In fact, they go to the extent of saying any offense punishable under the customs law within the Indian customs water, he may be arrested. So therefore, for the purpose of administration, Indian customs water is relevant. But for the purpose of taxability, that is not much relevant. That will not have much relevance, right? Also, goods may be confiscated and vessel may be stopped in Indian customs water. The same is found to be used in smuggling. So, therefore, the authorities can go beyond 12 nautical miles and see if there are any vessels which are engaged in illegal activity, and it can also go for confiscation. Further, prohibited goods can also be confiscated if brought within the customs water. So, basically, for the purpose of administration, we have extended the territorial waters to exclusive economic zone. So, which means we have extended the definition of India up to 200 nautical miles. But for the purpose of taxation, India includes territorial waters of India. Therefore, up to 12 nautical miles will be considered as India. I hope this distinction you are able to draw. So, in chapter 1, unit 1, there isn't much to discuss. There are two definitions which are relevant, excepting that all other things are just basic stories about customs law. We can directly go to unit 2, chapter 1, where points relevant to our examination will be there. Right. Unit 2 starts with levy and levy of customs duty. Right. Now, as I told you, please understand that levy for customs is on two events. One is import of goods, second is export of goods. Right? Now, one issue that may crop up is this. I told you that moment it touches 12th nautical mile, it becomes import of goods because customs law says once you import goods into India, you have to pay tax. India is defined to be up to 12 nautical miles from the baseline. So therefore, moment a ship enters into the territorial waters, certainly import of goods have happened. There could be multiple issues in this scenario. One, these 12 nautical miles and all is only imaginary line. There is no actual line drawn. So therefore, it is practically difficult to identify. And secondly, sometimes what can happen is your ship without space, what can happen is it can come to the harbor. The harbor personnel can divert your ship saying there is no space. For temporary purposes, you land your ship in Mumbai harbor. After that, you can come here. So therefore, there will be multiple issues in ship entering into India. Now, why this issue is relevant is since the levy is on import of goods, moment it touches 12 nautical miles, it becomes imports, and customs authorities may ask you for taxes. So therefore, there are a lot of issues. Now, finally, those issues were settled with the Supreme Court decision. Those things we will be seeing now, right? As I told you, the charging section. What is charging section? In GST, you would have seen supply is a charging section, right? Likewise, charging point for the purpose of customs law is goods imported into and exported from India. So these two terms are very, very relevant. Goods imported into or goods exported from India, which means technically speaking, moment the ship touches 12 nautical miles, it is deemed to be an import of goods transaction, and the charge will automatically get attracted because the language used is goods imported into India, right? Now, right. Now, coming to the issues that I told you, they have highlighted those issues. Section 12 makes it abundantly clear that importation or exportation of goods into or out of India is the taxable event for payment of customs duty. Earlier, lot of problems were faced in determining the point at which face. The root cause of the problem was definition of India. As I told you, India includes territorial waters. Moment a ship touches territorial waters, it became import. Under the said section, India includes territorial waters of India. Consequently, even an innocent entry. So let us assume a vessel has to go to some other place, not India, but through India it has to go to some other place. But by mistake it touches territorial waters. It will become an import of goods transaction. So therefore, there are a lot of issues like that. Consequently, even an innocent entry of a vessel into the territorial waters of India would result in import of goods. Further, it was almost impossible to determine when exactly vessel crossed the territorial waters limit. But this matter is no longer res integra. What is res integra? This is being finalized by a decision. Supreme Court has given a decision as to at what point in time you have to levy tax. That is what we are going to see now. Very important from exams perspective. So, as a background, I told you that there were some issues that were being faced with respect to taxability because of the definition of India. Even a ship which does not intend to come into India but innocently passes through India because it touches the territorial waters. For them also, this levy attracted because it will be deemed as import of goods because it includes territorial waters also. Consequently, department was asking for taxes, right? So therefore, to put everything into a conclusion, Supreme Court came with a decision, right? We will see what does the Supreme Court observe. In case of goods cleared for home consumption, in case of goods cleared for warehousing. Before going to the decision, see what can happen is when you import some items into India, two things that can happen. One, you do not want to clear the goods immediately, either because you do not have money to pay the duty, because without paying the duty you cannot clear the goods, or due to some other reason, already your warehouse is filled with goods, therefore you do not want to take the goods immediately. So what you can do is, there will be warehouse in the customs place. You can transfer the goods to warehouse for temporary purposes. There are detailed rules and regulations for warehouse. I am not going with it. That is also not available for an examination. But please understand that an importer has two options when he imports goods. One, he can take it for home consumption. What is home consumption? He can take it, he can pay the customs duty and take it to his premise. That is called as clearance for home consumption. Or alternatively, he can also clear it for warehousing. What is warehousing? I do not want to take the goods immediately on account of financial or other reasons. So temporary purposes, I take the goods and keep it in warehouse, customs warehouse for some time. Under both these circumstances, the charging section says import into India. Supreme Court has differentiated at what point in time import of goods is deemed to have been completed, and in case of warehousing, at what point in time import of goods is deemed to have been completed. Therefore, for the purpose of examination, we have to see, for the purpose of charging a transaction under customs, whether it is cleared for home consumption or whether it is cleared for warehousing. In case goods cleared for home consumption, Supreme Court observed that import of goods will commence when they cross the territorial waters, but continues and is completed when they become part of the mass of goods within the country. Beautifully they have given. So they satisfied both the things. They did not go beyond the law. Territorial waters certainly includes India. They said import will commence once you cross territorial waters, but continues and is completed when they become part of the mass of goods within the country. So they say, ship comes into India, you unload it. Once you unload it, it becomes part of the other goods in the customs place. So it says import commences moment the ship crosses the territorial waters, but continues and gets completed once the imported goods becomes mass of the goods within the country. So very beautifully they have defined at what point in time charge of import duty will be there under the customs law. So therefore, import commences once the ship touches the territorial waters, and it continues and gets completed once they become part of the mass of goods. Right? The taxable event being reached at the time when the goods reach customs barrier and bill of entry for home consumption is filed. So they first told us what is that, when is import commencing and when is import completing. Now they are saying at what point in time taxable event is arising. They say taxable event being reached at the time when goods reach the customs barriers and bill of entry for home consumption is filed. So beautifully they are given. So your goods are imported now. From vessel it is unloaded. From unloading, you should clear those goods for home consumption. At that point in time, levy of customs duty will be there. So beautifully they have defined. Firstly, they have told clearly that import will commence moment it crosses the territorial waters. Then they say it is completed when it becomes part of the mass of goods. And they say taxable event. At what point in time tax is leviable is when you file bill of entry for home consumption. Very beautifully defined. The term has been beautifully interpreted by Supreme Court. So very, very important from exams perspective, which means even though you unload goods in the customs place, taxable event does not get attracted. Only when you clear it for home consumption by filing bill of entry, taxable event gets attracted. So therefore, they have put the debate into rest by saying when import commences, when it is completed, and when taxable event gets attracted. Right? This is the case of Garden Silk Mills versus Union of India. Okay, so this is a case of clearance for home consumption. What is if it's a case of clearance for warehousing? That's what we are going to see. In case of warehoused goods, customs barriers would be crossed when they are sought to be taken out of customs and brought to the mass of the goods in the country. Very, very simple. Now, in case of warehouse, what happens? I do not immediately take the goods out of the customs space and take it to my premise. What I do is I temporarily transfer those goods to the warehouse. Right? They say once you take the goods from warehouse, customs barriers would be crossed when they are sought to be taken out of customs and brought to the mass of the country. Which means once you take the goods out of your warehouse and when you try to clear it for home consumption, at that point in time, for whereas the goods taxable events get attracted. This case is in the case of Kiran spilling mills versus collector of customs. These two case laws are important from exams perspective. One is garden silk mills, second one is Kiran spinning mills. They define at what point in time taxable event gets attracted. Okay, right. And as I told you, I told you what is the difference between home consumption and warehousing, right? Now, the first part of discussion, whatever we have discussed till now, is not that much important. But what we are going to discuss now is very, very important from exam's perspective. Very, very frequently asked question in exam. Duty liability in certain special circumstances. Listen to it very, very carefully. Lot of concepts are involved, and if you miss out something, then you'll be when you read it again, it will be very difficult for you to understand. Very tricky. Okay, right. Now we have to understand one point. When I say import or export, do not assume import to be a purchase transaction, export to be a sale transaction. What is that you are saying? I am not able to understand. That is, when I say import goods, what you normally assume, I am purchasing some material, I am purchasing some plant and machinery from abroad. No, please erase that understanding from your mind. The word import or word export simply means this. This we have already seen in GST. Any goods that comes into India is imported. Any goods that goes from India to abroad is exported, which means it need not necessarily be a case of sale. So when I say import, it is not at all a purchase transaction. There can be a transaction where I can probably, my friend can give a gift to me, therefore that is not a purchase transaction. Or some samples can be received by a company, that is not a purchase transaction. Therefore, please understand, whenever I use the word import of goods or export of goods, please do not assume that it will be a purchase transaction or a sale transaction. An import of goods is clearly defined under the customs law, as is the case for GST. So both the definitions are similar, right? So, having understood this, I will tell you two scenarios. You tell me whether customs duty is leviable or not. Let us say I export goods on 1st January 2020. Now, on February 1st, 2020, my customer abroad is finding out some fault with my goods. So therefore, what he is doing is, he is sending back the goods to me for repairs. So I exported on 1st January 2020. Since there were some issues with the goods, he is now giving back the goods to me, and I have to repair the goods and send back. Now please understand, in this case, there are two exports, one import. What is the two export, one import? Actually, there is only one export that has happened. There is neither a purchase. That's why I told export, import, do not understand from the perspective of a purchase sale. When I sent the goods on 1st January 2020, that was an export transaction. When he returned back the goods on 1st February 2020, that was an import transaction. When after repairs, let's say on March 1st, 2020, when I'm again sending back the goods, there is again an export. So therefore, please do not assume that export or import means purchase of sale. In one transaction of sale, there can be multiple transactions of export or import. In my scenario, since the second leg of transaction, that is, I export on 1st January, I again re-import on 1st February. In this case, customs duty is very much payable because it's an import. For import, customs duty is payable, right? But you might think that this is an unfair charging of customs duty because your intention is not to import, your intention is to only repair and send it back. So, law is trying to envisage lot of types of transactions where the import is not the intention, but the intention is some other reason. Therefore, they are giving some concession in customs duty. So, what we are going to discuss now is duty liability in special circumstance. What are the special circumstances? In some circumstance, the actual intention is not to import. But since the word import is satisfied and accordingly levy is attracted, I might have to pay tax. For those transactions, the law is trying to give some concession. That is what we are going to see now. Let us start. Again, as I told you, it is slightly tricky when I start discussing the content. Please be attentive. Okay. concession. The first type of concession for a case where concessional duty payable in case of re-importation of goods exported for repairs or exported under duty drawback. I'm not going into what is a duty drawback, etc. Please understand, this is a case where I initially export goods, right? For repairs, again I am re-importing. In our typical case where I told you 1st January I am exporting, on 1st February I am importing. That is called as re-importation of goods exported for repairs or exported under duty drawback. I'll tell you one point. If you are finding it difficult to reconcile with this terminology of re-import, export, etc., I'll simply tell you like this. You visualize an example like this. 1st January I exported, 1st February I am importing. This is a scenario which is covered. Like that, if you understand as an example, it will be better because the language used is very, very technical. You might get lost. Therefore, I would request you to visualize these things which I'm discussing with an example in mind. So that is the example that which has to go into your mind. In that case, what is the concession that the law is giving? That's what we are going to see now. Right? They are dividing the scenario into two. One, goods exported under claim for duty drawback, refund of integrated tax paid on export of goods, bond without payment of integrated tax, amount of import duty payable if re-imported, amount of incentive availed of at the time of export. Second scenario, goods other than those falling under serial number 1 exported for repairs abroad, duty of customs which should be leviable if the value of re-imported goods after repairs were made up for the fair cost of repairs carried out including cost of materials. And you did not even understand a single point from whatever I read. Okay, this is just to give an example that if you read directly customs like this, you won't understand anything. You should always have an example in mind. Okay, now let us take an example. Let us continue the same example. 1st January. So what is that we are discussing? In case where I export first and then re-import for repairs, there is a concession given for me because this re-import after export is considered to be an import of goods whereby duty of customs is leviable. Therefore, law is providing some concession. I'll tell you what the concession is and then we will read, you will understand. The concession is very simple. They say, let us assume for 100 rupees, okay, $100, that is not in 100 rupees. For $100, I have exported goods from India on 1st January 2020. Now, those goods are returned back by my customer for repairs. I am doing repair. The total cost of repair is, let us say, $10. For repairing this item, total cost that I incur is $10. Department says, or the law says, I agree that you are not actually importing goods, but you are certainly doing some value addition, right? You are doing repairs. It's a value addition. To the extent of value addition, pay tax. That is the concession given. Normally, what would have happened? Going with the valuation rule, you would have re-imported. You should have again paid import duty on $100. But as a concession, what they are saying is, I agree that your intention is not to import, but you are certainly importing repairs. So therefore, there is some value addition. Please pay tax on the fair value of repairs. Is what they say. So in a scenario where I export first and then re-import it for the purpose of repairs, then in that case, a concession is given to me. Normally, I would have paid duty on $100. Now it is enough that I pay duty on $10. I hope this example you have understood. Do not read serial number 1. Come to serial number 2. We will complete serial number 2 and then go for serial number 1. Goods other than those falling under serial number 1 exported for repairs abroad. Okay, duty of customs which would be leviable if the value of re-imported goods after repairs were made up of the fair cost of repairs carried out. So therefore, see how they are saying duty of customs which would be leviable if the value of re-imported goods after repairs were made up of fair cost of repairs carried out. So therefore, they say, for all you are re-importing for repairs, please pay duty on fair cost of repairs. So You have to understand this point very clearly. Your goods may be under warranty. That doesn't matter. Since you are going to re-import it, you have to compute the fair value of cost of repairs. That will be given in the question itself. Carried out, including cost of materials used in repairs. Let us assume I am exporting, let's say, a grinder. Now, the customer is saying he is not satisfied with the grinder, he wants to do some repairs. After doing repairs, I also change some material. Let's say I'm changing a coil in the grinder. In addition to the cost of repairs, that is service component, whatever material that you use in repairing, that also you should include for the purpose of customs duty. Used in repairs, whether such costs are actually incurred or not. So therefore, this is what I said. Warranty, no warranty doesn't matter. You are incurring it, not incurring it doesn't matter. In fact, even if he purchases and gives you a material, that is also to be included. And also insurance and freight charges, both the ways. This is very, very important. This is where students make a lot of mistake. Please understand, it is the fair cost of repairs plus materials if any used, plus for importing, two costs has to be incurred. One, no transaction of import can happen without insurance. So for ship, you have to necessarily obtain an insurance, take the insurance cost, and freight cost. Obviously, if you are going to transport goods from, let's say, US to India, transportation cost will be incurred. So therefore, fair cost of repairs plus material cost plus insurance and freight to and fro. So what will happen is it will be re-imported for repairs. After repairing it, I will be exporting it again. So therefore, to and fro insurance charge, to and fro freight charge will have to be added. To summarize the discussion, we are now discussing some duty payment under special circumstance. The first circumstance is a case where I initially exported goods, now I am re-importing for the purpose of repairs. In this case, law says you have to pay duty on the fair value of cost of repairs plus materials if any you use for repairing it, plus to and fro freight and insurance. Very frequently asked question in the examination. In fact, after it, they are asking this even in compulsory question. I hope you are able to understand this particular concept. Okay. Now, I ignored serial number 1 because without understanding duty drawback, you will not be able to get this particular point. But anyway, I'll just broadly explain it. Anyway, tomorrow, when you're going to see duty drawback, you will be able to appreciate it. The first scenario that they are saying is, in certain cases, what happens is when you export, to encourage export, benefits like duty drawback, benefits like a refund of IGST and all is given. What are the circumstances under which it is given? I'm not going into that. Let us see it for tomorrow. But whenever you are exporting it under some benefit like duty drawback, refund of IGST, the concession is whatever incentive that you avail. So you avail duty drawback, you avail refund of integrated tax, that alone you repay. You will not pay any customs duty for re-importation. You only use the incentive that you avail. So they have divided the re-importation in case of original export into two. One is a case where it is re-imported for repairs. I'm not availing any benefits such as drawback, refund of IGST, etc. In that case, very simple to identify: fair cost of repairs plus materials plus insurance to and fro plus freight to and fro. In case where I have availed some incentive in the form of duty drawback, in the form of refund of IGST, etc. In that case, the duty payable from your side is whatever incentive you availed, please pay that amount back as duty. So first part we have completed. I hope you are able to understand this. If I am fast or something like that, you can put it in comments. Okay. So let us move on to the next special circumstance duty payable. And please understand there are conditions attached to it. Let us see the conditions. Time limit for re-importation. Time limit for re-importation is 3 years. So what happens is on 1st January 2020, I exported the goods. The goods that I exported, I cannot send it for repairs after 3 years. At the maximum, I can send the goods by, let us say, 1st January 2023. So, therefore, you cannot send the goods for repairs forever. Right? This concession is given only if the re-importation happens within 3 years. Like it can be extended to 5 years. You have to get a special permission from the department. If they accept for some extraordinary circumstance, it can be extended to 5 years. which means what? If at all it crosses 3 years or 5 years, as the case may be, you have to pay duty on the normal value, import value, that is $100, not on the $10. Okay. Same goods, exported goods and the re-imported goods must be the same. So this is very obvious. Naturally, it has to be the same, export goods and re-imported goods. No change in ownership. So the person to whom you sold should be same person, because some types of frauds can happen because you export something, but what you are importing is different. You actually export to some person, some other person is giving no. You can play with these kind of things. So therefore, that's why they have clearly laid down conditions. Okay, we will not go into the concessions not applicable. We will see this after some time, not now. Okay. All right. Now, scenario number 2. Scenario number 2 is this. Same example. 1st January 2020, I imported goods. In the first case, we exported, now we are importing. Let us assume on 1st February 2020, the imported goods had some defect. So what I do, I send back the goods to my supplier and ask him to do some modification and give it to me in a workable form. So this is a case where importation first happens and then export happens because there are some defects in the product, and again re-importation happens once the goods are repaired. In this case also, technically speaking, the last leg of the activity is an import activity, because I'm receiving the goods initially, sending the goods to abroad, and again receiving the goods back to India. So technically definition is satisfied, import of goods definition is satisfied, therefore tax is variable. But they say if you are re-importing it in this circumstance for repairs, etc., then you need not pay any duty. So therefore the distinction between first scenario and second scenario is exemption is given there. There some concession is given. What is the difference between concession and exemption? Exemption now you will not pay duty at all. Concession means yes, you will pay duty, but at a concession rate. So therefore, first difference is the transaction that we are talking about is import, export, again import. In the first scenario, export, import, again export. Like that, if you remember, you will be able to appreciate. In case of export, import, export, you are given a concession. That is fair value of cost of repairs. In case of import, export, and again re-import, in that case, exemption is given for you. No need to pay any duty, because your intention is not to import goods. Your intention is there is some defect on the goods imported. Now that you have cleared the defect, you are going to use the goods now. Right? Let us see what is the concession given. Right. 1. Goods manufactured in India and re-imported for repairs or for reconditioning other than specified goods. So they have divided it into 2 parts. One is goods manufactured into India and re-imported for repairs or reconditioning. Second one is goods manufactured in India and re-imported for reprocessing, refining, remaking. So therefore, they are dividing the entire transaction into 2. One is for repairs or reconditioning. Second is reprocessing, refining, remaking. So therefore, if you are going to entirely reprocess the transaction or refine the goods that was initially imported, you will be covered under scenario 2, or entirely remake the goods. Scenario 2, otherwise it is scenario number 1. In both the scenarios, exemption is same. There is no difference in exemption. Only difference is conditions attached to the exemption will differ from this case to that case. Okay. So what are we discussing? We are discussing exemptions from customs duty in case where I import goods initially, I export it for repairs and then re-importing for the purpose of once the goods are removed from defects. So they are dividing into 2. One for repairs, second reprocessing, refining, remaking. Right? In both circumstances, under both the circumstances, there is no difference at all with respect to exemption. Duty you will not pay. Only difference is time limit. Time limit for re-importation. 3 years in case of Nepal, in case of export to Nepal, and such time limit is 10 years. Sorry, so normally it is 3 years. In case of export to Nepal, it is 10 years. Okay, in case of reprocessing, repairing, remaking, etc., it is 1 year. So which means once you export it for the purpose of repairs or for that matter reprocessing, etc., you have to get back the goods within 3 years or 10 years in case of Nepal and 1 year in case of reprocessing, refining, etc. And there are other conditions to be satisfied. Goods must be re-exported within 6 months of the date of importation. Please understand, this is very, very critical. See, there are two things. One is re-importation, second one is exportation. Do not get confused. I'll give an example. With the same example, let me try to make you understand. So let us say, same example, 1st January, I am importing the goods. The goods that I've imported, if I have to avail this concession, I have to re-export it within 6 months, which can be extended to 1 year of the date of importation. So 1st January I am importing. I have to export it for repairs or export it for reprocessing, refining, etc. within 6 months, or which can be extended to 1 year. So which means any repairs for which you are exporting goods beyond 1 year time, maximum 1 year time, you will not get this exemption. You have to pay customs duty. So one of the main condition is the re-exportation should have happened within 6 months, which can be extended to 1 year from the date of importation. Second, assistant commissioner or deputy commissioner is satisfied as regards the identity of goods. So there can be a fraud which can happen. So the goods that you imported and goods that you are exporting can be different. You can do fraud so as to avoid customs duty. Therefore, you have assistant commissioner or deputy commissioner will verify whether the imported goods and the exported goods are one and the same. So therefore, you have to satisfy the AC or BC. The importer at the time of importation executes a bond. So you should also execute. So tomorrow, if they find out that some fraud has happened, since you have availed exemption, they will invoke the bank guarantee that we have given to pay the customs duty. So to summarize the discussion, the first scenario that we saw for special circumstance duties is first export, then import, and then export. In that case, some concession is given. Whatever is the fair value of cost of repairs plus material cost plus insurance to and fro will be the value on which you pay customs duty. Second is a case where you are importing first, then exporting, then re-importing, either for repairs or for reprocess, remaking, reprocessing, refining, etc. In this case, complete exemption is given for customs duty, provided you follow the certain conditions. The first point, the maximum time limit for re-importation is 3 years. So this time limit is different from this time limit. This time limit is the maximum time. Let's say I'm importing, I'm exporting it again. What is the maximum time within which I have to receive the goods from my supplier for re-importation purposes? That is 3 years. In case of reprocessing, refining, it is 1 year. So in case of re-exportation, so I have imported it. Within what time I have to export for repairs? It is 6 months, it can be extended to 1 year, and you have to satisfy AC or DC as regards the identity of the goods. And the last condition is you have to execute a bond. I hope this concept also you are able to understand and appreciate. In illustration 1, whatever we have discussed is given as a problem. This problem has been tested multiple times in the examination. Okay, they are very fond of this problem. Illustration name alone they will change, but nothing else they will change. I would request you to see it after class. Okay. Now, so we are continuing with tax payment under special circumstance. Okay, where as I told you, 1 or 2 questions is for sure from this chapter, and mostly they might ask some problem also. And this problem for information is asked in compulsory question, not in your normal problem. So therefore, please understand the concept. If at all you have any clarification, you can ask me. Right, let us move on. So the first scenario, what we saw is export, import, export, import, export, import. Like that, if you understand, you have to. So in case of import, export, import, exemption. In case of export, import, export, it is concession. Now, moving on to different other scenarios where special duty payable is mentioned under the customs law. We will start with section 21. Okay. Now, before reading any section, we will first try to understand with an example and then read it. You see, what can happen is your goods, when it starts from, let us say, I'm importing from USA. When it started from USA, there were 100 tons of, let us say, a particular chemical. 100 tons of chemical you are importing. But when it reaches the customs place, let us say you receive only 99 tons. Okay. For 1 ton, what happened is it got derelicted. What is derelict? Your ship got abandoned. So what you do is your goods came in 2 ships. One ship completely got abandoned into the sea with no hope of recovery. So therefore, you lost those goods. Should you pay customs duty or not? Is one question. Second, sometimes what happens is to avoid the ship from sinking, to reduce the weight of the ship, they will throw away some goods from the ship or vessel. In that case, the question is whether customs duty has to be paid or not, right? And in some cases, what can happen is your entire vessel can be cast ashore by, let's say, big tides, etc. In those cases where some unnatural things happen, due to which you are not able to import the entire quantity, for the difference in quantity that you are importing, should you pay import duty? So when I say difference of quantity, let's say initially when it started from the origination, it is 100 tons. But ultimately, when it came to Indian customs place, it was only 99 tons or 98 tons. The difference of 1 or 2 tons, should you pay import duty or not? Is there any concession? Is what we are going to discuss. Okay. Let us read it now. All goods, derelict, jetsam, flotsam, and wreck, brought or coming into India, shall be dealt with as if they were imported into India, unless it is shown to the satisfaction officer that they are entitled to be admitted dutifully under this act. So, we will see the terminologies, derelict, jetsam, etc., the meaning of it, and then come to section 21 again. Let us see the meaning. Derelict. This refers to any cargo, vessel, etc., abandoned in the sea with no hope of recovery. I think you would have seen this case where some in Madras port this happened. Huge liters of oil spilled in the sea, and though that ship was not at all recoverable, they were trying to recover that ship. It was not at all possible. Finally, they had to dismantle or do something with the ship at that point in time. So therefore, whenever a vessel is abandoned in the sea with no hope of recovery, that is called as derelict. Second, jetsam. This refers to the goods jettisoned from the vessel to save her from sinking. That these terminologies are very frequently asked in objective types. So they will say jetsam means. They will give all these four options. You have to see what jetsam exactly refers to. It refers to a scenario where, in order to save the vessel, you jettison some goods. Very simple. I told you that sometimes because of overweight, there could be risk of ship getting sunk. At that point in time, what you will do is you will throw away some goods to reduce the weight of the vessel. So therefore, that is called as jetsam. Flotsam. Jettison goods which continue floating in the sea are called flotsam, which means you throw away some goods. If it floats, it is called as flotsam. Wreck. This refers to cargo or vessel or any property which are cast ashore by tides after shipwreck. This is complete destruction of the ship itself. There is a difference between derelict and wreck. In case of derelict, the ship is very much there, but you are not able to take the ships from that place to the place of port. This is abandoned. The wreck is a case where complete destruction, your ship is cast ashore by the tide after a shipwreck. So therefore, these are all the terminologies which we have to understand section 21. Now, if you read section 21, it says, in case of derelict, jetsam, flotsam, wreck, etc., normally you have to pay customs duty. Very, very unfair, right? Goods itself is not there. It has not even come to India, but then they are asking to pay customs duty. Yes, as per section 21, you are supposed to pay customs duty. However, if you are able to prove that derelict has happened or jetsam happened, flotsam happened, wreck happened, in that scenario, you will be able to escape from duty liability. In that scenario, you need not pay tax if you are able to prove to the satisfaction of the proper officer that they are entitled to be admitted duty free. So which means we are able to justify these scenarios that derelict has happened, jetsam happened, flotsam, etc. Then no duty. But normally duty is paid unless and until you prove it. I hope this concept also you have understood. Let us move on. Okay. So I would have commented this right hand side whatever I gave. What is the importance level? These are all not important. These are all procedural aspects. Whatever is important from exam perspective, that alone I'm going to teach. These are all procedures. Okay. Let us start with. Of course, they are not done with your special duties and special circumstances. There are few more scenarios which we need to discuss. Before discussing that, one basic point I want to discuss. You see, when you import goods, the first issue that we saw was at what point in time it is given that import goods. Where we saw garden silk milks, where it clearly said import commences once it enters territorial waters, it continues and gets completed once it becomes part of the mass of goods. And the liability to pay tax or the charge attracts once the goods are cleared for home consumption. This is what we understood. Now, the issue would be this. Let us assume the rate of duty on the goods you import on 1st January it is 12%. On that day, your ship came into India. It is in territorial waters, right? However, when you cleared goods for home consumption on 5th January, the rate was increased from 12% to 20%. The question is, what rate of tax is applicable? So the next issue to be discussed is, on what date I have to see the rate of duty applicable. Please understand, there is one more aspect to it. There are two rates. One is exchange rate. I am not talking about exchange rate. There is one more debate. At what date I have to take the exchange rate and which rate I have to take, RBI rate or CBS rate, that's a separate debate. I am not going to it. What we are going to see now is the rate of tax on customs duty for import of goods, percentage, 10%, 15%, etc. For that, what date I have to consider? Is it the date of import? Is it the date of filing home consumption? Is it the date of payment, etc.? That is what we are going to discuss. Really, it clearly makes a distinction between warehousing and home consumption. Always there will be a distinction in rate of duty, etc., between warehouse and home consumption. Let us see that. Section 15 prescribes the relevant date for determining the rate of duty and tariff valuation, if any, applicable to any imported goods in the following manner. Okay. In case of goods entered for home consumption, the rate of duty and tariff valuation shall be the rate and the date of presentation of bill of entry or date of entry inwards, whichever is later. I will discuss elaborately what is this. And goods are cleared for home consumption, date on which bill of entry for home consumption is presented. Any other goods, date of payment of duty. So very simple. It says it divides the scenarios into broadly two categories. Any other goods to be divides into two categories. One cleared for home consumption, second cleared for warehouse goods. We know why goods will be cleared for warehouse instead of home consumption, financial or other reasons. So when the goods are intended to be cleared for home consumption, in that case, the rate of tax applicable will be the later of date of presentation of bill of entry. What is date of presentation of bill of entry? You will file bill of entry with the customs authority. You will present the bill of entry. What is bill of entry? It basically is a document which contains all the particulars relating to your goods that you are importing. Right? So you will present it to customs officer. He will verify all the details. He will ask you to pay tax and then clear the goods. So on the date on which you present the bill of entry, that date compared with date of entry inwards. What is date of entry inwards? I told you on 1st January, vessel came into India. That is the date of entry inwards, which means the date on which the ship comes in territorial waters or ship touches the border of India or territorial waters, that date is called as date of entry inwards. You have to compare date of entry inwards with date of presentation of bill of entry. Whichever is later would be the relevant date for the purpose of rate of duty. Okay, so what we are saying, we are now trying to identify what percentage of customs duty is applicable for us. In that we are saying, in case where goods are cleared for home consumption, it is date of presentation of bill of entry or date of entry inwards, whichever is later. In case goods cleared for home consumption, it is date of presentation of bill of entry. So therefore, home consumption, there is no issue. One question which students are many times asked is, how can the date of entry inwards be earlier than date of presentation of bill of entry, or vice versa? Normally, you will ship will enter into the territory of India and then you will unload it and then only file bill of entry, right? But no, there are some circumstances where your entry inwards can be certainly later than bill of entry. What can happen is, I want to urgently input goods. So what I do is, I file the bill of entry today. My ship has started from USA. Now today itself I am filing the bill of entry because I urgently need to import goods. Once the ship comes into India, I will immediately unload it, already bill of entry filed, pay the customs duty and clear it. So in those circumstances, it is possible that bill of entry date can be earlier than date of entry inwards. In that case, the date of entry inwards will be relevant for the purpose of calculating rate of duty. I hope you are able to understood. So I hope you are understanding what I am discussing. We are now discussing the concept of rate of duty. So we have divided the rate of duty into two: clearance for home consumption, and then the second part is warehousing. Clearance for home consumption, date of entry inwards or date of presentation of bill of entry, whichever is later. And in case where it is warehouse goods, it is always date of presentation of bill of entry. Okay. Now there was one issue which came up. Further, there is a Supreme Court decision. I'll tell you what. See, what happened was, now one ship came to Chennai for unloading. Now what happened was, due to non-availability of space, the port personnel asked the ship temporarily to go outside, okay, and park it somewhere. And then after some point in time, ship again came to that place. The question is, date of entry inwards will be, let's assume some dates. 1st March 2020, a ship touches the territorial waters. Therefore, entry inwards gets attracted. Now, due to some reasons, the ship is going back to some other place for something. Let's say it's going to Mumbai port or some other port. And finally, on 10th March, it is going to land at particular port. Let us say it's Mumbai or Chennai, whatever it is, right? In this case, the question is the date of entry inwards 1st March 2020 or 10th March 2020 was the issue. There is a Supreme Court decision in the case of Bharat Surfactants Private Limited. That decision says, in this case, date of entry will be 10th March 2020. The date on which finally you are landing the ship in that particular place will be the relevant date. Let us read this case. This is also very important. Section 15 has generated a lot of interest in terms of case law development. In Bharat Surfactants Private Limited, Supreme Court held that rate of duty and tariff valuation would be done on the date of final entry of the ship. So initially there was an entry, ship again went back to some place, and finally it is entry, so date of final entry. In this case, a ship entered Bombay and made prior entry on 4/7/81 for the first entry, at which time duty was 12.5%. Since there was no space, ship proceeded to Karachi and after that came back to Bombay on 23/7/81. So on account of not space availability, it went back to Karachi and then it came on 23/7/81. On which date the rate of duty was 15%. Which date you will take 15%? Because Supreme Court has held that whenever there is a question of one prior entry and then it goes back and then there is final entry, the relevant date for the purpose of identifying date of entry inwards will always be date of final entry of the ship. Therefore, this is also important from the exam's perspective. Okay. They have given one more example. I would request you to see that. Okay. Now let me take 2 minutes break. After the break, very important discussion: remission, abatement, and exemption. I told you there's a possibility of 2 questions in this chapter 8. The first question will be from the discussion that we made: import, export, import, export, import, export, etc. Those kind of scenarios, concession. Second is this scenario, very frequently asked. Normally they ask this in seventh question, not seventh question, last question. There will be A, B, C, D. In A or B, this question you will see. Always you will see remission, abatement, and exemption. Very interesting. This involves some concept. It will be very interesting. Let us see that after 2 minutes break. Very important from exam's perspective. Do not miss it. Hello. Okay, so class. Tax on பைசா போடுறதுலாம் வந்து லோன் சொன்னா டாக்ஸ் பண்ண முடியாது. இப்படி வச்சுக்கலாம் அவ்வளவுதான். டாக்ஸ் கிடையாது, இப்படிலாம் டாக்ஸ் கிடையாது. எந்த வருஷம் 19 இருக்குதா? பட் ஆனா இப்ப சப்மிட் பண்ண முடியாது, இந்த ஃபார்மே வரல. இந்த ஃபார்மே வரல. ஓகே, ஹெட் ஃபார்ம் இருந்தா சீக்கிரமா ட்ரை பண்ணலாம். ஃபார்மே வரல. சரியா? நான் வாங்கும்போது என்ன சொல்றேன்? சரி. Let us start or continue with chapter 1, remission, abatement, and exemption. Right. So, three terminologies are used: remission, abatement, and exemption. All these three terms have different meanings. So, what is an exemption? What is a remission? What is abatement? Can you separate question difference? Exemption means you need not even pay the duty. Let us say on a particular goods imported, you are supposed to pay 12% duty. If there's an exemption provided, you need not even pay a single percentage. This is exemption. What is abatement? You need not pay 12%, you pay 30% of 12%. Some concession is given on the total duty payable. That is called as abatement. Then what is remission? There are only two scenarios. One, fully exempted or partly exempted. What is the third scenario? Remission. Remission is a scenario where you pay the full duty now. Initially, you pay the full duty. Afterwards, after happening or non-happening of an event, you refund, you claim the refund of whatever duty you paid. So exemption and remission principally may be same because you are getting the entire amount of duty that you pay. Though in exemption you are not even paying duty, net flow could be same. But exemption is not even paying any duty. Remission is paying duty and claim the refund of the duty that you paid initially. So therefore, those are the differences between remission, abatement, and exemption. There are various scenarios under customs law. In some scenarios, remission is given, some scenario abatement is given, under some circumstance, exemption is given. Let us see all these three circumstances now. Okay, let us start with section 13. Let me give an example and start with section 13. You see, since customs is a very, very huge place, there is always this threat of your goods being theft. Okay, small petty theft, 1 kg, 2 kg, there is always this possibility. So let's assume I imported goods. Okay, now the threat of theft need not be in the customs place. Let us assume when the goods are in the vessel commences from abroad, before it reaches customs premise, during that period also there can be theft. Okay, so therefore the first scenario is theft in technical terms is called as pilferage. So pilferage means theft in small quantities, so not large theft, theft in small quantities. In case of pilferage, what is the duty exemption that is available? Is there a duty exemption available? If so, what are the conditions that one has to satisfy? Is what we are going to see now. Let us read it. If any imported goods are pilfered after the unloading thereof, underline the word after the unloading thereof, and before the proper officer has made an order for clearance for home consumption, please understand that this pilferage technically under section 13 is applicable only when there is some theft happening after unloading. It means ship has come into India and you have unloaded the goods. After unloading the goods, but before clearance for home consumption, what order passed before clearance for home consumption? It means that I unload the goods, I decide to take the goods for home consumption. Now what I do, I have to file the bill of entry. I file the bill of entry. After filing the bill of entry, officer will verify whether particulars are correct or not. After verifying it, he will pass an order for home consumption. Using that order only, I can clear the goods from customs place to my place. So during the intervening period, after unloading but before order for home consumption, if at all there is any pilferage, the importer shall not be liable to pay the duty leviable on such goods, which means it's an exemption. So in case of pilferage, but what is pilferage is what is important. It is not a case where I told two scenarios. One is you start your vessel from abroad. During the vessel journey also there can be some pilferage. That is not covered here. Please understand. This pilferage is only that pilferage which happens after unloading but before the order for clearance for home consumption. Right? So therefore, in that case, you need not pay duty. However, where such goods are restored to the importer after pilferage, importer becomes liable to duty. Let us say there's a CCTV camera in the customs place. Let's say this is a gold that you're importing. If it's a normal other goods, there is no issue. Gold you're importing, if some pilferage is happening, it will be huge value. Let's say in CCTV camera, you're able to identify who has stolen your goods. So you identify now your goods are restored. In this case, you have to pay duty. So whenever there is a restoration of goods that were pilfered earlier, there is duty liability. But normally, in case of pilferage, there is no duty. But pilferage should happen after unloading, but before order of clearance for home consumption. I hope you are able to understand this. Okay. Let us move on. Some points you will see. Okay, conditions, etc. Conditions to be satisfied for exemption from duty. The reason why this exemption is given is once goods are unloaded, there is someone called as custodian in the customs law. He will be the person who will be in charge for the goods. So therefore, it's absolutely out of my control. If something happens during that time, I should not be held responsible for payment of duty because the goods are under your custody only. Okay, but conditions to be satisfied. First, imported goods should have been pilfered. This we know. Pilferage should have occurred after the goods are unloaded. This is what is important. After the goods are unloaded, but before the proper officer makes the order of clearance for home consumption. So therefore, between the period unloading and clearance for home consumption, whatever happens, that is only considered as pilferage. And the last condition is pilfered goods should not have been restored back to the importer. This we know. If it is restored, you have to again pay duty. The term pilfer means to steal, especially in small quantity. That is petty theft. Okay. Therefore, this will not include a huge loss. Let's assume the entire lot is stolen by someone. That will not be getting covered here. Okay. And of course, you have to prove the following circumstance in which pilferage can be claimed. There should be evidence of tampering with the package. See, it's not, you cannot just like that say your goods have been stolen by someone. There should be some evidence of tampering. There should be blank space for missing articles in the package. So let's say there is 10 rows. One row was missing. Like that, there should be blank space for missing articles in the package. And the missing articles should be unit articles and not part articles. So it should be based on units and not parts. The point is to satisfy all these conditions, no one will satisfy. Okay, so in effect, pilferage and practically how much it is relevant, I don't know. But yes, there are conditions which has to be satisfied. And in addition to conditions, you should also ensure that there is no tampering, there is one blank space for the missing article. Therefore, too many conditions, of course. Theoretically very relevant, but practically I don't know how much it is relevant. Right, let us move on. So please understand one point. So the pilferage, when it should happen, laws clearly laid down. Between the period of post the unloading, before the order for clearance of home consumption. After the order for clearance of home consumption, you clear the goods from your place to some customs place to your place. During that time, whatever happens, even pilferage happens, customs duty will not be exempted up to the point of order for home consumption. Okay, that point you have to remember. So other points, I'll see if it is relevant, because in customs, one issue is with respect to study material, they will be repeating whatever they say tens of times in different ways. That's the only issue. That's why seeing what else should be relevant for our classroom purposes. All right. Let us go to remission of duty. As I told you, there is a difference between exemption and remission. Exemption happens when you are not even liable to pay the duty. Remission happens, you pay the duty and then claim refund of whatever duty you paid. Let us move on to remission of duty on goods lost, destroyed, or abandoned. This is section 23. What we saw previously was section 13. Okay, right. Let us start with section 23, where it is shown to the satisfaction of the assistant commissioner or deputy commissioner that any imported goods have been lost otherwise than as a result of pilferage. So if it is pilferage, section 30 is applicable. Otherwise than way of pilferage. So in addition to pilferage, if you lose your goods for reason other than pilferage, then this provision is applicable. Goods have been lost or destroyed. You lose your goods or your goods have been destroyed at any time before clearance for home consumption, the assistant commissioner of customs or deputy commissioner of customs shall remit the duty on such goods. So therefore, they can give a remission of duty for those goods which are either lost or destroyed. But this also should happen at any time before clearance for home consumption. After clearance for home consumption, you cannot do it. But only difference is there is no restriction as to after unloading, before unloading. It just says this event should happen before clearance for home consumption. That is the difference between pilferage and this particular section. Okay, right. So, as I told you, the first point you have to understand is this section 23 is a case where duty has been paid, but after paying the duty, you come to know that goods have been lost or goods have been destroyed. You can apply to the commissioner, assistant commissioner, deputy commissioner, and can ask for remission. Okay. So, analysis of 23 shows that it comes into play after the duty has been paid and even after an order for home consumption has been passed. So please understand, before clearance for home consumption, I can do it, which means order will be passed for home consumption. After passing an order, it's not necessary that I have to immediately remove the goods. There can be some time period. So during that time period, whatever happens, you can claim this remission. Unlike pilferage, where once order for home consumption is passed, they cannot claim any benefit. Right? In that case, provision is not that goods will not be liable to duty, but duty paid on such goods shall be remitted, which means you will pay the duty. So whether goods are lost or goods are destroyed doesn't matter, you pay the duty. But after paying the duty for that, you go to the assistant commissioner, deputy commissioner, you prove to him that goods were lost or goods were destroyed, and if he is satisfied, certainly he will remit the duty. Yeah. So therefore, when 23 will apply, when 30 will apply. In respect of goods which have been pilfered after they have been unloaded, but before the goods are cleared for home consumption or deposited in a warehouse, section 13 will apply, and the importer would not be liable to pay the duty. In cases where 23 is attracted, importer is entitled to remission of duty. Next, remission of duty is permissible only in case of total loss of goods. Please understand, it is complete loss of goods. This implies that loss is forever beyond recovery. So therefore, you should prove that the loss is forever and there is no recovery possible at all. But in case of pilferage, there is a possibility of recovery. I can find out the person who has stolen my goods and then recover it. The loss referred to in this section is generally due to natural causes like fire, flood, etc. So therefore, there's a tsunami which happens because of which your goods are destroyed, no hope of recovery. Like that, those kind of scenarios are covered. Loss referred to in subsection 1 may be at the warehouse also. So therefore, your destroying of goods can happen at warehouse also. It is not necessary that it has to happen only at the place of customs. Okay. But only point, as I told you, in the above situation, loss or destruction have to be proved to the satisfaction of the assistant commissioner or deputy commissioner. Thereupon, he may pass remission orders cancelling the payment of duty. In case duty has already been paid, refund can be obtained after granting the remission orders. Therefore, satisfaction of the officer is very, very important. Okay. Right. This hope you would have understood. What we discussed now is section 23, where we saw remission of duty is possible when goods after imported either are lost or are destroyed, and there is no hope of recovery and it's a permanent loss. In that circumstance, if you satisfy the AC or PC, then you can certainly ask a remission order. Remission is different from exemption. In remission, there is levy of customs duty. After levy of customs duty, after payment of customs duty, you will receive an order basis which you can claim refund of duty rate. Whereas in case of pilferage, there is no duty liability at all. I hope you are able to understand this. Okay. Now, before going to the next circumstance, let us discuss this. You see, what can happen is I import some duty. I import some goods. Let us say when I inspect the goods, I found it to be very, very defective. The typical example is, let's say, China goods. You would have heard about this, very, very poor quality. Let's say the quality of the goods are very, very poor. And my supplier is not willing to take the goods back. The Chinese fellow is not willing to take the goods back. Now, what I can do is, I can abandon the goods so that I can at least save the customs duty. Because there's a specific provision which says, if you relinquish the title of the goods, which means I imported, title of the goods belong to me. After importing, I feel that no, this goods will not be saleable in the market. Therefore, if I take the goods unnecessarily, customs duty will be a cost to me. In that case, what you can do is you can relinquish the title of the goods. If you relinquish the title of the goods, no duty liability will be there. That is the next scenario. Right to relinquish the title to the goods, abandonment of goods. The owner of imported goods may at any time before an order for clearance of home consumption. Again, the word order for clearance of home consumption is used. Under 47, or an order for permitting the deposit of goods in a warehouse under section 60 has been made, relinquished his title to the goods, and thereupon he shall not be liable to pay the duty thereon. So whenever you relinquish the title, there is no duty liability on you. There is demand. So this happens generally when the supplier is willing to take back the goods, and the cost of transportation from this place to the other country will be huge. Instead, if I remit if I relinquish the title, there is no customs duty, and cost of transportation, insurance, etc. will not also incur. Okay. So this is relinquishment. Let's see the analysis. Relinquish means to give over the possession or control to the government. As I told you, this is somewhat similar to pilferage. Before order for clearance of home consumption, this has to be done. Okay. So, what are the possible reasons why goods can be abandoned? Goods may not be according to the specification. Goods may have been damaged or deteriorated during voyage. So, when it came during the voyage, there was severe damage. Now, the supplier is not willing to take back it. He is saying, I am not responsible. I am also saying, if the goods are damaged, I will not be able to sell. So, in those cases, there can be a case of abandonment. There might have been breach of contract, and therefore the importer may be unwilling to take delivery of the goods. There will be some breach of contract as well, right? So with this, we are done with section 13 and section 23. To recollect, section 13 is pilferage, section 23 talks about two scenarios. One is loss or destruction of goods, the other one is relinquishment of title to the goods. Let us see the difference. They have beautifully articulated what are the difference between section 13 and section 23. Let us see. With this, your remission and this one is over almost. Right? First meaning, pilfer means to steal, especially in small quantities. Loss means permanent loss without any recovery. That is the meaning. Duty, importer no duty is liable on section 13. Section 23, yes, duty is liable, but it can be remitted. Paid can be remitted. Restoration is possible in section 13. Restoration not possible. Warehouse the goods. So please understand, section 13 is not applicable for warehouse because after unloading, but before clearance of home consumption. Section 13 is not at all applicable for warehouse goods, whereas 23 is applicable even for warehouse goods. Onus to prove the pilferage. Onus to prove, obviously, it is on the importer has to prove in case of destruction or loss to the satisfaction. Onus to pilferage does not lie on the importer as it is obvious at the time of examination by the proper officer. I don't see this as a difference. I don't think that this is a difference because even in pilferage, we have to prove three things. One, there is a blank, this one in the order of the goods, etc. Therefore, I don't know how they are saying this is a difference, but anyway, they are saying this is a difference. Time of occurrence of pilferage. This is certainly a difference. This is after unloading before order of home consumption, whereas at any point in time before home consumption, loss or destruction can happen. Okay, So therefore, we are done with the remission of duty. We are done with exemption of duty. Last point that we have to discuss is abatement of duty. With this, almost we are done with this chapter 1. Let us start with abatement of duty. Okay. Now, so what can happen is you have imported goods, but there is some small damage or some deterioration that has happened to goods. Department cannot completely waive off the duty because there is some portion which is still recoverable. At the same time, they cannot give complete refund, remit the duty because there is certainly some hope for you because it is not completely damaged. If it is completely damaged, it can be categorized as loss, right? So therefore, these are scenarios where there is certainly damage. The damage is not 100%. To some extent, there is damage or deterioration. That is what we are going to see now. Okay, let us see that. What is the benefit that is given? Okay, the benefit is very, very simple. You have to calculate the value. Just a minute. Yes. So very, very simple. I'll tell you logically how it works. Let us assume the value of goods before damage is 100 rupees. The value of goods after damage is 80 rupees. This 20 rupees proportionately you can claim duty exemption. Let us say the total duty you have to pay is 10 rupees. If value of goods before damage is 100, value of goods after damage is 80, 20% is the value of damage. Then 20% you can claim this abatement. This is what I told as abatement when I discussed earlier. Some portion of the duty will be claimed as exemption. That's what they would have given us formula also. That's the logic of this formula. Okay, let us read it. Where it is shown to the satisfaction of the AC or DC that any imported goods has been damaged or had deteriorated at any time before or during the unloading of goods. So please understand, at any time before or during the unloading of goods in India. So therefore, there's a very clear distinction between section 13 and 23. Okay, so your damage or deterioration. Nika, 10 o'clock in the meeting. Right. So this damage or deterioration, please understand, this damage or deterioration should have happened before unloading or during unloading. So any damage or deterioration after unloading is not at all permissible under this section 22. So goods had been damaged or had deteriorated at any time before or during unloading. So you should have necessarily proved that before unloading or during unloading some damage or deterioration happened to the goods. Okay, that any imported goods other than valued goods had been damaged at any time after the unloading thereof, but before their examination under section 17 on account of any accident not due to any willful act negligence. So it clearly bifurcates this entire damage into two. One, those damages which occur before, this point is very, very critical. This is slightly tricky. Please listen to it very carefully. One type of damage is that damage which happens at the point of unloading or before unloading. This is one type of damage. Second damage can happen after unloading happens. The distinction between these two is this. If it happens before unloading or during unloading, you need not prove to anyone that damage has happened because of me, not because of me, willful, whether it is intentional damage, etc. But when a damage happens after unloading takes place, you have to prove that this damage is not on account of your willful act, negligence, or default. So therefore, to summarize, both the damages are covered under this particular section, but that damage which occurs after unloading, we have to prove to the officer that it is not on account of your willful act, negligence. But if it is happening before unloading or during unloading, there is no such proving mechanism. Okay, that any warehouse goods had been damaged at any time before its clearance for home consumption on account of any accident, not due to any willful act, negligence, or default of owner, is employer agent. Such goods shall be chargeable to duty in accordance with the provisions of subsection 2, which means 22 subsection 2. Okay, so therefore, they say simply whenever these kind of circumstances occur, there is some benefit given to you. That benefit, how it has to be computed. Duty to be charged on the goods referred to in subsection 1 shall bear the same proportion to the duty chargeable on the goods before the damage or deterioration which the value of the damaged or deteriorated goods bears to the value of the goods before the damage or deterioration. They will try to confuse you. It's very, very simple. Calculate the value after deterioration, calculate the value before deterioration. The difference is there, no, that percentage of value of duty you will not pay. In our example, 100 rupees is the value before deterioration, 80 rupees is the value after deterioration, 20 rupees is the deterioration or damage. To the extent of 20%, there is exemption from duty. If you see the formula, that is the crux of it. Of course, you have to satisfy the proper officer. Those things are there. I'm not going to that. Okay. So they have again explained whatever we have discussed. So to see this table is very, very critical, because there is no, please understand that damage you can claim before unloading, after unloading, during unloading. But this condition, this accident or damage is not due to willful act, negligence, is applicable only if it is after unloading or if it is an accident in the warehouse. So therefore, for these two circumstances, you have to prove that it is not on account of a willful act. But any damage happens before or during unloading, you need not prove it to anyone. Okay? Right. Formula. Whatever we discussed, it is given as a formula. Duty on goods before damage or deterioration into value of damage divided by value of goods before damage. So therefore, value of damage divided by value of goods before, it will give you that percentage. Okay, that percentage into duty. If we calculate, that is the duty chargeable after abatement. What they are trying to compute is what is the duty payable after abatement. For calculating the abatement, the formula that I told you can apply. Okay, so therefore, what you have to do is very simple. Calculate the value before damage, calculate the value after damage, try to identify the percentage of damage. That percentage of damage will be your abatement. The remaining percentage will be tax payable. As simple as that. Do not get confused with the formula. Okay. They are given illustration. Okay. So value of goods is 10,000. After damage, the value is 2,000. Then the duty payable on 10,000 should be approximately reduced to 20%. So therefore, very, very logical. Okay. I would request you to solve this illustration 5. Very, very important. They have covered almost all scenarios. The problem is, since we have seen various circumstances such as exemption, remission, abatement, etc., the conditions for all these scenarios are slightly different. And at what point in time a damage can happen, at what point in time a pilferage can happen, at what point in time loss or destruction can happen, will differ. Therefore, I would request you to prepare a table covering section 13, 23, 22. You will have a perfect clarity. Okay. So we are almost done with this chapter. The last concept in this chapter is denaturing or mutilation of goods. Okay. Now, what happens is sometimes you import goods. The rate of duty on the imports differs whether you use this particular goods for A purpose or B purpose. Let us say I am importing alcohol. Now this alcohol can be used in liquor. This alcohol can be used in chemicals. Alcohol sometimes are used in medicines as well, in your sanitizers and other things. So the alcohol rate, the rate applicable for alcohol that is imported, differs on whether you use it for sanitizer, whether you use it for some other purposes, liquor or something. So therefore, how the department know that this item which is imported, that is alcohol, is used for A purpose or B purpose? Obviously, what I will say, no, whatever rate is the lowest rate, I will say I imported only for that purpose, but actually I will be using for some other purpose. Department will not be able to come back and see for what purpose it is being used. What they do generally do is they mutilate. What is mutilation? What they do is, for whatever purpose you are going to say that you are going to use the goods, they will make sure that you cannot use this alcohol for any other purpose. They will do some coating. Of course, it's a very technical discussion. I do not know what they will do for alcohol, but one practical scenario that I have seen, this neem seed, you know, right? This neem seed that was imported. Now, this neem seed was supposed to be used for the purpose of agriculture, but however, if it is used for agriculture purpose, then the rate of tax was different. If it is used for non-agricultural purposes, the rate of tax is different. What people used to do is they import the neem seeds and they will say they are using it for agricultural purposes. They will pay concession rate of duty. In order to stop the misuse, they were doing one more neem coating. They were doing some coating on the neem seeds so as to prevent this kind of misuse. So possibly they were using it for extracting oil from the neem seed, etc. They were using it for some other commercial purposes. Once the coating was done, that did not affect the agricultural purpose. Okay, but you cannot use it for any other purpose. You can use it only for agricultural purpose. Therefore, that is called as mutilation. They will change the character of the goods that they are importing only to use it for that purpose for which you are importing. For which you say it's importing. You cannot use it for some other purpose. Like that they will do. They will either denature it or mutilate it. That is what is called as denaturing or mutilation of goods. Okay, provider an importer can request central government to make rules. Okay, this and all is not required. Okay. If any imported goods can be used for more than one purpose and duty is variable on the basis of the purpose of utilization, then denaturing or mutilation of such goods is useful. By denaturing, goods are made unfit for other purposes. After denaturing, processed goods can be used only for one purpose and accordingly duty can be levied. Right? So therefore, to summarize, denaturing, if they ask in theory, is nothing but they will change the nature of the goods so as to use it only for the purpose that they are importing. Other purposes you should not use it. Because the rate of duty sometimes can be different for different purposes. So with this, these are the relevant points which we need to discuss for the purpose of examination. All other points, I would say, are not important at all, are important but not pure theories, which for which there won't be any big value addition as such from my side. Whatever I have highlighted, in addition to that, I would request you to read. Other points, yes, these are all case laws which they have given. I would suggest you to read the substance of the cases. They would have given particulars. That alone you read. Case law citation you will not remember because of late they have stopped asking case laws. So therefore, don't waste time. So with this, we are done with chapter 1. We will start with chapter 2, let's say in 2 minutes time. What you have to do is, again, please read the customs first chapter immediately, because what happens is this concept of export, import, export, this and all is very, very tricky, because you wouldn't have seen this practically. Since I have seen some things practically, I'm able to correlate some things which they are saying. But theoretically speaking, very difficult to visualize certain scenarios, and especially as pilferage, destruction, etc. Practically what happens, you do not know. That's why once you see this video, immediately if you read it and try to solve some problems, you'll be able to get a decent grade. Okay, so let us meet after a small break and start with chapter 2. Okay. Yeah. Let us start with chapter 2, types of duty. So from exams perspective, can expect, let's say, short one question from theory. In addition to that, of late they are asking objective types as well for 2 marks. So certainly yes, important. Let us start. You see, this chapter though covers lot of areas. For the purpose of our class, I will be discussing only limited types of duties, but other types of duties I will tell you just orally. When they say types of duty, they are talking about customs duty. They are also talking about integrated tax. They are also talking about additional duty. So, if you look at prior to the introduction of GST law, there was something called as additional duty. There was something called as special additional duty. These duties were levied in lieu of excise, in lieu of VAT, etc. Since for certain goods, even though VAT law and excise law is applicable, they have still retained it. But you should stop asking questions from those types of areas, that is additional duty, special additional duty, countervailing duty, etc. Therefore, I'm not going into those areas. I'm directly going into those areas which will be very relevant for your exams perspective, like your safeguard duty, like your anti-dumping duty, etc. Okay. Now, let us start. Let me share the notes. So broadly, there are 2 types of duties. One is revenue duties, second is protection duties. What is the revenue duty? What is the protection duty? Very simple. Revenue duty is a duty which is levied for the purpose of raising revenue, which means suppose the government wants to raise more revenue, they will say one more duty, A duty, B duty. They will be keep on adding duties because government wants revenue. the objective of revenue duty is to increase the revenue, right? Whereas the objective of protective duties is to safeguard interest. It can be safeguarding interest of any type. Let's say, for example, some particular goods are imported in large quantities from a country, because of which your domestic manufacturers are getting seriously injured. So therefore, they can levy extra duty in order to ensure that import from that country reduces significantly. In fact, 2 days before you would have seen, import of calculators from Maharashtra was subject to anti-dumping duty because the import from Malaysia was very large and the value of import was significantly lesser than the value of selling in Malaysia, which means if the calculator costs, let's say 100 rupees in Malaysia, the import duty of the calculator normally should be 120, 130, but it was 80, just to give an example. So therefore, these are all cases where to safeguard the interest, Indian interest, they can levy. So that is called protective duties. So we will be more concerned about protective duties in this chapter. Revenue duties, yes, your customs duty itself is a revenue duty. Your GST itself is a revenue duty. So therefore, I'm not going to that. We already know what is revenue duty. We will be discussing mostly about this protective duties. Let us start. The first type of protective duty is safeguard duty. Okay. Let's see what is safeguard duty, why it is levied, under what circumstances it can be levied, etc. Okay. So safeguard duty can be levied in the following circumstances. Any article is imported into India in increased quantities. So some articles are imported in increased quantities. Such increased importation is causing or threatening to cause serious injury to domestic industry. So from a particular country, you know from which country this happens. I do not want to even name the country. Increased quantities we are importing. You would have known this famous this one in Tamil Nadu, crackers, importation of crackers from one particular country. Under that circumstance, what happened was the import was happening in increased quantities. Such increased quantity importation did actually really impact the domestic industry. So if these are the two conditions that satisfy, in that case, central government can levy one more duty called as safeguard duty. Please understand, this is in addition to your customs duty, your other duties and cesses. If there's something else, social welfare such as cess, that also you charge. You charge GST also in addition to the safeguard duty. This is not in alternative to, this is an addition to. Okay. So objective is to safeguard the interest of any domestic industry in India, aiming to make it more competitive. Some points which need to be considered is, as we see different types of duties, you will be able to appreciate it. Safeguard duty is product specific because some duty is country specific. So from one country there will be increased import, not only for a product but for many products. Then what you will do is you will impose some restriction on the country itself. You will increase the duty for the country itself. That is called as some other duty, anti-dumping duty. I'm not going to that now. But this is called a safeguard duty, which is product specific. When a particular product is imported in increased quantities, to control that and to make the domestic industry competitive, this particular duty is levied. Let us move on. This duty is in addition to any other duty in respect of such goods levied under this act or any other law. So, as I told you, this is an addition to, it is not a substitution to or alternation to. Education cess and higher education cess is not paid on safeguard duty. Yes, education cess and higher education cess is not even applicable now. As of now, what is there is social welfare substances. Therefore, this point is actually redundant. For any duty levy, it will not be levied forever. There will be some time period. That time period is there. Duty imposed under this section shall be enforced for a period of 4 years from the date of its imposition. So normally, for 4 years, this duty will be imposed. Beyond 4 years, it won't be imposed. So therefore, normally from the date of imposition, it will be in effect for 4 years. Extension of period. Central government may extend the period of such imposition from the date of its first imposition, provided it is of the opinion that domestic industry has taken measures to adjust to such injury, or as the case may be to such threat, it is necessary that safeguard duty should continue to be imposed. Maximum period to 10 years, which means normally it is 4 years, but however, due to some reasons, if government feels if domestic industry is still facing that issue, or to safeguard the industry, we have to, it is 4 years is not sufficient. In that case, it can be extended to 10 years, which means safeguard duty normally it will be effective from the date of imposition to 4 years, but which can be extended to further period of 6 years, that is 10 years, maximum 10 years, safeguard duty can be levied. Okay. So all the provisions of customs law with respect to refund, levy, assessment, etc., will be applicable to safeguard duty as well. Now, the structure for discussing all these type of duties is first applicability, when it will be applicable, under what circumstance it is applicable. Second, number of years for which it can be levied. Third, conditions, if at all any condition is there for levying it. Last one is exemption. There will be exemptions provided for levying a particular duty. That is what we will see at the end. So exemptions from safeguard duty. Articles from developing country. Articles originating from developing country, so long as the share of imports of that article from that country does not exceed 3% of the total imports of that article into India. Let us take an example. Exemption is divided into two categories: articles from developing country, articles originating from more than one developing country. Let us see first scenario number 1. Let us say, let us take one example. Let's say India is trying to impose safeguard duty on mobile phones. Okay, now mobile phones not okay because each mobile phone is different. Let us assume a scenario of, let's say, a pen, right? So from one country, there are huge quantities of pen that is being imported, right? Now, if they are going to see whether I have to impose safeguard duty on that product, what I have to see is whether that's a developing country or not. Okay, if it is a developing country, then we have to see the total value of import from the country. Let us assume, let us for example sake, from Australia we are importing pens in increased quantities. Let's say total import across globe for India is, let us say, some 1 lakh quantities. This for example. From Australia alone, we are importing, let us say, 2000 quantities. So total imports from across the globe is 1 lakh. From Australia alone, you are importing 2000. Okay. Let us assume other conditions are satisfied. That is, it is causing injury to the domestic industry, etc. Other conditions are satisfied. But since total percentage of imports from that particular country is less than 3%, the government will not impose safeguard duty, which means if I am importing from a developing country and the percentage of import from the developing country is less than or equal to 3%, then in that case, no safeguard duty will be levied. I hope you are able to understand this. Okay. So this is exemption A. Exemption B, articles originating from more than one developing country. I hope you have understood example A. Exemption A. This is second exemption. Articles originating from more than one developing country. Articles originating from more than one developing country, so long as the aggregate of imports from developing countries, each with less than 3% import share, taken together, does not exceed 9% of total imports. Let us try to visualize this. They say this 3% condition remains same. This 3% condition, there is no difference at all. But in addition to that, they say you have to also look at from what all developing countries we are importing this pen. Let us assume in our case only developing country, Australia is actually developed country for the sake of example. Now let us say like Australia and importing goods from 2 or 3 more countries. I should see two things. One, individually 3% is crossed or not, and collectively all the developing countries put together 9% is crossed or not. If either 3% is crossed individually or 9% is crossed globally from developing countries, then safeguard duty exemption is not available. So to summarize, there is one circumstance where safeguard duty is exempted. Circumstance number one, articles from developing country. Whenever you import articles from developing country, in that circumstance, if the percentage of import from that developing country is less than or equal to 3%, then there is exemption. Whenever I import articles from more than one developing country, if all the developing countries put together it is 9% or less, then no issue. Of course, individually also it should be 3% or less, there is no issue. Otherwise, there is no exemption at all. Import duty is very much payable. So safeguard duty is very much variable. I hope you are able to understand this. Let us move on. Okay. This point C is very, very important here. Very frequently asked. This point C. In the exemption part, this is a common exemption not only for safeguard duty, but also for your anti-dumping duty. I will tell you why and how. You see, whenever your EOU or special economic zone imports something, we all know that what is 100% EOU? They will only be doing export transaction. What is SEZ doing? SEZ unit also predominantly is engaged in exports, right? So in those cases where that unit itself is set up only for the limited purpose of export, it doesn't make sense to levy safeguard duty because it will not cause any injury to the domestic industry. You understand? Because I am importing and exporting. Therefore, there is a need for exemption being provided to 100% EOU or special economic zone. That's what they say. Safeguard duty shall not apply to articles imported by 100% EOU or unit in an SEZ or unit in SEZ unless specifically made applicable. Therefore, normally if there is a notification saying safeguard duty will be imposed on this product, normally it is not applicable unless that notification itself says for SEZ and EOU also is applicable, or the articles imported is either cleared as such into DTA or used in the manufacture of any goods that are cleared into DTA, and in such cases, safeguard duty shall be levied on that portion of the article so cleared or so used as was leviable when it was imported into India. So, see the distinction, they clearly make a distinction. They say, logically also this is correct. If the SEZ unit or EOU imports it and uses it or clears it to DTA, then it will cause injury because when I'm importing and exporting, no domestic flow is affected. But I'm importing and selling to domestic or DTA, domestic tariff area. What is domestic tariff area? Other than SEZ area or other than EOU area. If I'm selling to them, naturally there will be injury costs. So therefore, under two circumstances, your exemption to import of 100% unit, import by 100% unit or SEZ is not applicable for safeguard duty. One, we will specifically made available to a notification, or when the article imported is as such cleared into DTA and used in the manufacture of goods that are cleared into DTA. Under these two circumstances, safeguard duty is applicable. Otherwise, normally safeguard duty is exempted for SEZ and 100% EOU. Just a minute. Yes. Let us move on. So you have to understand one point. The safeguard duty levy now is not a very simple thing. There involves a lot of analysis. We have to see exactly what percentage has to be levied, what is actually the injury cost to the domestic industry. So therefore, there are a lot of factors involved in a safeguard duty. Therefore, what they generally do, they will levy a provisional duty. Provisionally, they will assess something and then levy. That is called as provisional assessment. Central government is also empowered to impose provisional safeguard duty pending determination of final duty. Let us assume I know for a fact that this product is imported in bulk quantities, but I exactly do not know the injury cost to the domestic industry. Therefore, provisionally, immediately to curb this import, I impose something that is called as provisional assessment, provisional duty. Provisional duty may be imposed on the basis of preliminary determination that increased imports have caused or threatened to cause serious injury to domestic industry. Provisional duty shall be imposed for a maximum period of 200 days from the date of its imposition. Please understand that government cannot take its own time forever. For 200 days, provisionally you can impose something. But beyond 200 days, you should certainly either say that there is no injury cost or either say that there is injury cost. If there is no injury cost, whatever duty that they levied initially, that will be withdrawn. If there is no injury cost, sorry, if there is injury cost, they will continue to levy, but probably they will change the rate of duty depending on the actual injury cost. So therefore, to summarize, there is something called as levy of provisional duty. Provisional duty will be levied whenever, provisional duty will be levied because the government is unable to determine exactly what is the rate that is applicable. So what they will do is provisionally they will say this is the safeguard duty that is payable. This can be in effect for a maximum period of 200 days. After final determination of this duty, either they can not impose duty at all or they can impose duty, depending on whether injury is caused or not. Therefore, this is with respect to safeguard duty. I hope you have understood this concept of safeguard duty. Okay. I'll come to this countervailing duty later. Let us complete other duty, anti-dumping duty. So what is the section number for safeguard duty? It is 8B, right? It is 8, correct, 8B. So section 9 is anti-dumping duty. Let us see anti-dumping duty. 9A of Customs Tariff Act. Okay, this is an interesting scenario. You have to listen very, very carefully. Okay, see what happens is this is a classic case of Malaysia example that I told. Recently, 2 days before, Government of India took a stand that anti-dumping duty will be levied. So as I told you, the value of sale in Malaysia for the calculator was rupees 100, but the import value when it was imported into India was 80 rupees. So having this example in mind, let us read this anti-dumping duty portion. When the export price of a product imported into India is less than the normal value of like articles sold in the domestic market of the exporter, it is known as dumping. So in this case, exporter is the Malaysian country. Export price is priced in that particular country. When export price of product imported into India is less than the normal value of like articles sold in the domestic market of the exporter. So you compare the value of sale in Malaysian market, that is domestic market of the exporter, with that of the imported value. If at all, if the value of export is less than the value of like articles sold in the domestic market, then there is a dumping. First of all, I'm not concluding that anti-dumping duty is levied. I'm just saying what is a dumping. Let us first understand what is dumping, then move on to when anti-dumping duty can be levied or not levied. So this is called as dumping, right? Dumping is normal value in the export market, okay, is less than export price. Is called as dumping, right? So let us read. Let us continue to read. Although there is nothing inherently illegal or immoral in exporter charging a price less than the price prevailing in domestic market, designated authority can initiate necessary action for investigation and subsequent imposition of anti-dumping duties if such dumping causes or threatens to cause material injury to the domestic industry of India. So therefore, the point we understood is initially they will go for an investigation and find out whether actually there is any injury caused. If at all there is any injury, only then they will go for this particular duty. So first thing what they will do is they will investigate if there is any price which is imported into India and they will compare the price in the domestic market. If at all there is any dumping, first they will identify that. Once they identify the dumping, the next step is to whether levy anti-dumping duty or not. Okay. Suppose if they feel yes there is dumping, but there is no harm caused to the industry, there is no issue at all. So anti-dumping action. So dumping means this. Just because there is dumping doesn't mean that anti-dumping duty should be levied. For that, there are other conditions. Anti-dumping action can be taken only when there is an Indian industry which produces like articles when compared to the allegedly dumped imported goods. Further, this duty is country specific, that is imposed on imports of particular. Please understand, this is the difference between safeguard duty and anti-dumping duty. With respect to safeguard duty, that is product specific. As far as anti-dumping duty is concerned, it is very, very specific to a country. So therefore, that is the difference, right? Let us move on. Right. Under the General Agreement on Tariffs and Trade Provisions, anti-dumping duties higher than the margin of dumping cannot be imposed. Right. So when you are levying anti-dumping duty, it cannot be higher than the margin of dumping. What is margin of dumping? We saw the price at which it was sold in the domestic market, price at which it is sold to India, imported value. This margin can be the maximum value that you can levy as duty. However, a lesser duty which is adequate to remove the injury to the domestic industry is permissible. I'll give you examples in numbers, you'll understand. In India, the government is obliged to restrict the anti-dumping duty to the lower of the two, dumping margin and injury margin. So this will be the next subject matter of discussion. Anti-dumping duty that is levied, if at all levied, should be restricted to lower of dumping margin and the injury margin. So we need to understand what is an injury margin, what is a dumping margin. Whichever is lower will be the anti-dumping duty, right? 9A provides that where any article is exported by an exporter or a producer from any country or territory to India at less than its normal value, then upon importation of such article into India, central government by notification impose an anti-dumping duty not exceeding the margin of dumping in relation to such article. So, as I told you, the margin of dumping is restricted to dumping margin or injury margin, whichever is lower. They say first identify whether there is some dumping, do some investigation. Once there is some dumping, please go for anti-dumping duty. Okay. Now we have to go to the computation of margin of dumping and injury margin, because anti-dumping duty is calculated based on margin of dumping or injury margin, whichever is lower. Right? Let us see what is margin of dumping. Margin of dumping is very simple. It means the difference between its export price and normal value. It is generally expressed as percentage of the export price. So very simple. Difference between export price and the normal value. We need to know the definition of export price. We also need to know what is the normal value. Export price in relation to an article means of goods imported into India is the price of an article exported from exporting country or territory. Very, very simple. For what value I am importing the goods, that is export price. Goods imported into India is the price of an article exported from the exporting country. So when I'm importing, let's say from China, whatever value I'm importing, that is called as export price, right? Why are we understanding export price? The margin of dumping, the formula is export price minus normal value. So export price means the normal price for which you import, right? What is normal value? In relation to an article means comparable price in the ordinary course of trade for the like article when destined for consumption in the exporting country or territory as determined in accordance with the rules. Very, very simple. Let us take one example and understand this. In China, let us say this one pen is sold at ₹8. Same pen, when they are importing it, they are importing it for 6. In this case, ₹8 is their rate. This is called as normal value. The value at which goods are sold in the domestic market of the exporter. What is your export value? Export value is the value at which the Indian purchases that particular pen from the Chinese market. I am purchasing it for ₹6. Therefore, export price is 6. Therefore, the margin of dumping will be ₹2. I hope you are able to understand this. So, normal value minus export value will give you the margin of dumping. So, We have to compare margin of dumping with the injury margin. Whichever is lower will be the anti-dumping duty. We have now understood margin of dumping. We will now understand injury margin. Right. Injury margin is the margin adequate to remove injury to the domestic industry. It is the difference between fair selling price due to the domestic industry and the landed value of dumped imports. Very, very simple. What is, I will tell you logically and then come to each and every terminology. Okay. Now they say, I have to now remove the injury to the domestic industry. There are two possibilities. I take two values. One, I see actual value of dumping. What is the difference between the value of sale in that country and value of sale to India? I compare both these values, I get a value. But if the fair value at which the goods are sold is much higher in India, then this particular formula will not make sense. In other words, I find out the value at which goods are sold in India, that is fair selling price. Fair selling, difference between fair selling price, non-injurious price, which is the price at which it is sold in India, and the landed value of dumped imports. I find out the value of the import price at which Chinese fellows giving me, at what cost is giving me. That price I'll compare with fair selling price. This fair selling price minus the imported value will give me some margin. That is called as injury margin, which means basically what is the price, what is the lower price at which he is giving compared to the domestic market. Let's assume this pen is sold for ₹9 in the domestic market. If the Chinese fellow is giving it for ₹6, the injury is ₹3 because if I'm a customer, I go to a shop, will I buy same pen which is available in the market, domestic market for ₹9, or there is one imported pen which is sold for ₹6. So therefore, I will buy only for ₹6. This ₹3 is the injury. Therefore, domestic selling price minus the import price will give you injury margin. This injury margin you have to compare with your margin of dumping. Whichever is lower will be your anti-dumping duty. I hope you are able to understand and appreciate this. If you summarize this with an example with numbers, you will be able to appreciate it. There are some problems, there are some illustrations given. You can look into that. Now, what the other country can do is, it has been happening, it is happening even now. So instead of pen, they will change the article name, or let us say there is a different. They will do some differentiation when they are importing. They won't call it a pen. They will add some features, small one sort of a rubber or something. They will add some add-on features. They will add and then differentiate the product. Therefore, but it will be still sold at ₹6, but they will do some differentiation in order to escape this, because what product I'm comparing with the domestic industry and that particular country should be same. So in order to escape from this anti-dumping duty, they might sometimes differentiate the product. If they are doing that, they can even levy anti-dumping duty on that differentiated product as well. So there are some conditions given for levying that. I'm not going to that. You can see that all those are logical conditions only. Okay. Now next one, you have to compare again with the safeguard duty. In safeguard duty, we saw something called as provisional imposition of safeguard duty, where we saw for 200 days this can be provisional levied. After 200 days, you have to either see whether there is any injury. If there is no injury, you can certainly not levy safeguard duty. Likewise, there is a provisional anti-dumping duty when determination of normal value and margin of dumping in relation to any article in accordance with this section. When central government may impose anti-dumping duty on the basis of provisional estimate of such value and margin. If the provisional duty is higher than the margin finally determined, then central government shall reduce the anti-dumping duty and shall also refund the excess duty collected. So please understand, obviously this is a process. I have to find out the price in that particular country. I have to then find out what is the price in this country. There's a lot of things involved. So therefore, what I can simply do is, as of now, based on some information, I will levy anti-dumping duty. Once I come to the final conclusion that this is the actual injury margin or this is the margin of dumping, after finding out if at all I have levied extra, I will be refunding the value. So therefore, provisionally I can levy anti-dumping duty, but there was some time limit for provisional levy of safeguard duty, but there is no time limit given for provisional anti-dumping duty. So therefore, it looks like it is unlimited, but yes, there is no specific time limit given for anti-dumping duty. Yes, let us move on. This point we have already seen. If you compare safeguard duty, we have already seen no anti-dumping duty for articles imported by 100% EOU. There we saw EOU as well as SEZ, but here there is only EOU, right? So those two conditions are applicable. Normally, anti-dumping duty is not applicable to EOU. Same logic, unless specifically made applicable, or the articles imported by EOU is sold to domestic tariff area. Same condition is very much applicable. Now, retrospective effect. Before seeing that, just give me a minute. I just have a water and some. Okay. So we are now seeing anti-dumping duty. We have completed safeguard duty, right? So what you have to do is when you are revising or studying after this, you have to on one page you have to write the safeguard duty provisions. Second, anti-dumping duty, because very often they ask the difference as well. And if you compare and contrast, it is also very easy to answer in the examination. So therefore, I would request you to write in a note what is the difference between anti-dumping duty and safeguard duty. Just give me a minute time and have a water. us continue. Right. So, in some circumstance, the government can levy this anti-dumping duty retrospectively as well. What is retrospective levy of anti-dumping duty? Very simple. See, for any levy of duty, there has to be some notification, right? Let us say June 1st, they are coming up with a notification saying anti-dumping duty can be levied. Now, though this notification came only on June 1st, they can make it applicable, let's say from May or April. But there is some restriction. Retrospectivity has some restriction. That's what we are going to see. So, notification date need not be necessarily the date from which it is effective. It can be retrospective also. From which date the retrospective effect can go, that's what we are going to see. So, notwithstanding anything contained in subsection 1 and 2, a notification issued under subsection 1 or any anti-dumping duty imposed under subsection 2 shall not apply to articles. Okay, this we saw no anti-dumping duty applicability. We have to see retrospective applicability. Sorry. Right. If the following conditions are satisfied, then the central government may, by the notification in the Gazette, levy anti-dumping duty retrospectively from a date prior to the date of imposition of anti-dumping duty. So, notwithstanding anything containing any law of the 1904, such duty shall be payable at such rate and such date as may be specified in the notification. So, they specify in the notification itself as to from which date this is applicable. So, the retrospective date from which duty is payable shall not be beyond 90 days from the date of such notification. So, this is what is important. Let us assume on 1st June 2020, there was a notification. That notification can certainly say it is applicable from prior to, let's say it is applicable from May or April. But they cannot go beyond April. They cannot say it is applicable from March because it cannot cross 90. Sorry, not March, February. March, April, May, 3 months, approximately 90 days. But it cannot go beyond 90 days. So therefore, retrospective notification possible. In the notification itself, they will say the date. But retrospective date cannot be beyond 90 days from the date of notification. But the retrospective applicability itself is subject to two conditions. What are those two conditions? First condition, there is a history of dumping which caused injury or that the importer was or should have been aware that exporter practices dumping and that such dumping would cause injury. There is historically a case of dumping. This country always indulges in this particular activity. Therefore, historically, there is a case for dumping. This is scenario number 1. Second, the injury is caused by massive dumping of an article imported in a relatively short term, which in light of the timing and the volume of the imported article dumped and other circumstances is likely to cause a seriously undermining the renewal effect. So very simple, if the dumping is very huge, that it is causing serious effects to the domestic industry, under these two circumstances, certainly you can levy anti-dumping duty retrospectively instead of prospectively, right? So the next point is period. We saw safeguard duty can be levied for a period of 4 years, which can be extended to a further period of 6 years. We saw. Likewise, there is some limit, number of years limit in case of safeguard duty, anti-dumping duty as well. Anti-dumping duty shall, unless revoked earlier, cease to have effect on the expiry of 5 years from the date of imposition. There we saw 4 years, which can be extended to 6 years. Here it is 5 years. Again, there is a time limit for extension, which can be extended for further 5 years. That is what it is given in this particular paragraph. So therefore, please compare the safeguard duty with anti-dumping duty, and there are a lot of common points. Chalk out the common points and also the differences, right? So therefore, time limit within which the duty can be imposed. It is normally 5 years, if nothing is said. Beyond 5 years, if they want, central government can certainly extend it for further period of 5 years. So this is with respect to anti-dumping duty. We will read. Okay. So what I will do is, there is only 15 minutes left. I left out this chapter. There are some areas which I am leaving it now, the types of duty. I left out this chapter called as audit extract yesterday. It will take only 10-15 minutes time. Let us complete this audit because too much customs is also not it will be slightly boring. So therefore, what we can do now is we will stop with this particular area of anti-dumping duty. There are two more areas which we will discuss in this type of duty. We will complete that audit under GST law, and then tomorrow we will start with this particular provision called as sorry, not particular provision. We will start with types of duty tomorrow. Okay, let me take the note and come. We will start with. I have not shared any notes for audit. I'll be doing it over this notes only, this virtual notes only. Let us start with audit and close for the day, right? Just a minute. All right, let's start with audit. All right. So if you broadly look at the chapter audit and assessment, in that chapter, in terms of audit, they have given only two types of audit, but there is one more audit which is given under the chapter called as accounts and records. So therefore, we will see all the three audits together. Let us not leave any audit, though only two audits are covered under that chapter, right? Let us start. The first audit is probably most of you would have known or practically seen, but anyway. The first audit, first type of audit is audit under section 35(5). This is what is your general GST audit, which is done by statutory auditors or chartered accountants. So this is a compulsory audit. It is done not by the department but by chartered accountant or a cost accountant. So therefore, who can do it? Who can do this audit? CA or CWA, right? When this audit can be conducted, when this is mandatory, when aggregate turnover, okay, during financial year exceeds 2 crores. So this audit under, this is type 1. Let's take type 1. We will do type 2 here. Type 3. Okay. So that we can compare all the three types of audit. Okay, so first type of audit is covered under section. This pen has some just a minute. So first type of audit is audit under section 35(5). Who can do it? CA or CWA. When it should be done? When the aggregate turnover is more than 2 crore in a financial year, right? So what a chartered accountant has to do? CA has to audit the accounts, and after that reconciliation statement to be submitted by the assessee. Okay, so last one, general point. So therefore, 3 points are relevant here. One, who can conduct the audit, chartered accountant or cost accountant, when it should be conducted, in aggregate turnover during financial year exceeds 2 crores, and what should be done after the audit. After the audit, a reconciliation statement has to be submitted by the assessee, right? So therefore, this is with respect to type 1 audit, that is audit under section 35(5). Let us move on to type 2 and type 3 audit. Okay, type 2 audit. If you could recollect our yesterday's discussion, when we were discussing section 61. What is section 61? Scrutiny of returns. There are different types of assessments that we saw. 59 was self-assessment, 60 was provisional assessment, 16 was scrutiny of returns. I told you that when during scrutiny, if some notice is issued and replace either not satisfactory or replace satisfactory, you have not made good the discrepancy that was made. That is, you have accepted the discrepancy, but you are not making any follow-up action. In those cases, the department can invoke section 65, 66, 67, and 73, 74. This we saw, right? So therefore, this is one type. Okay. Now this is section. This is the problem. This is section 65, right? This is section 66. Yesterday we saw, just to recollect this. Okay, this heading is audit by tax authorities. Okay. This one is special audit. So section 65 is audit by tax authorities. Section 66 is special audit. The first point to be understood is both these audits are to be performed only by department, or rather initiated by department, not conducted by department. In 35(5), only chartered accountant or cost accountant can do it. Initiation of the audit and completion of the audit. But under 65 and 66, both are at the discretion of the department. Department can probably in some audit can appoint chartered accountant or cost accountant. But generally speaking, 65 and 66 is with respect to department. He will ask the same questions. When can this audit be conducted? Right? At any point in time. At any time, this audit can be conducted. Department can at any point in time conduct this audit under 65. They just want to audit you, they can do it. There is no restriction at all. Okay. Here, when 66 audit can be conducted. Yes. Okay. When this audit can be conducted. Sorry for the one. See, there is an issue with this pen. So when this audit can be conducted, this special audit can be conducted only under special circumstances. The name itself suggests only under special circumstances it can be conducted. So when it can be conducted, the following circumstance: when scrutiny or inspection or investigation or any other proceeding. So let us say the department during scrutiny or investigation or inspection or any other proceedings under the Act, when they are doing this, they find out that either value incorrectly declared or credit not availed within normal limits. These things are given in your book. Okay. So if you read the entire theory like this, it will be very difficult. That's why I'm trying to compare it. So, and also due to complexity. Right. So let us compare all these three. First question, when this audit can be conducted? Under section 35(5), when the aggregate turnover exceeds 2 crores, by default audit will have to be conducted by a chartered accountant or cost accountant. Whereas under section 65, at any point in time they can conduct. There is no turnover restriction, nothing. Whereas under section 66, lot of conditions to be satisfied. During scrutiny, investigation, inspection, or any other proceeding, if the department, due to complexity, this should actually come here. Due to complexity, okay, and interest of the revenue, they find that value of supply is incorrectly declared, or input tax credit is not available within normal limits, which means department is either doing a scrutiny or investigation. They find out that you are definitely doing some wrong calculation with respect to value of supply, but the transaction is very complex. Department is able to visualize that there is a mistake committed by the assessee, but is not able to exactly quantify the mistake because the industry itself is very complicated industry. In that scenario, you can certainly go for special audit. So therefore, only for special audit, there are a lot of conditions. One, scrutiny, investigation, or any proceeding should be there, and there should be some department revenue loss which has to be foreseen by the department, and there should be complexity involved in this particular activity. And the issue here is value incorrectly declared or credit not available within normal limits. Therefore, all these conditions put together, if it is satisfied, only then special audit can be initiated. I'm sorry. Okay. So, to answer to the question when, we have answered for all these three types of audits. Next, who can conduct the audit? Who can? I'm sorry. Who can conduct the audit? Here it is start accountant, the cost accountant. Here, who can conduct the audit? Department will conduct the audit. Right? So when they say department, commissioner or officer authorized by him. So next question is, who can conduct the audit? In case of normal audit, the turnover limit audit, it is start accountant or cost accountant. In case of audit by tax authority, commissioner or he can authorize some officer. We have to see under section 66 who can conduct the audit. CA or CWA nominated by commissioner. So type 1 and type 3 in this regard are same. Who can conduct the audit? Here also CA or CWA. Here also CA or CWA. But the chart account or cost accountant will be nominated by the commissioner in this case. But whereas in case of section 65, the audit will be conducted by the department only. When I say department, either it is commissioner or officer authorized by the commissioner. Sorry, just a minute. Right? So therefore, we have understood the question: who can conduct the audit? When audit can be conducted? Under all these three sections. The next question is, of course, this will not be applicable. Where audit has to be conducted? In normal this audit, a chartered accountant can sit from his home, he can do anything. So therefore, there is no question of where. But here, there is a question of where. Where audit has to be conducted? In the place of business of assessee. Okay. So where this audit will be conducted? Place of business of the assessee. Right? Whereas in case of this particular there is no question. Chartered accountant can go to the premise of the client, not so this also mostly will be in the place of business of the assessee. Right? So answer to the question where is common for 65 and 66, but of course for where probably that may not be applicable to this normal audit. Next, purpose. What is the purpose of this audit? Any purpose. This audit can be, so which means this audit is a very broad audit. It can be initiated for any purpose at any point in time, so therefore there is no restriction in any aspect. Whereas here we already know the purpose is to safeguard interest of revenue, right? So here there has to be necessarily safeguarding interest of revenue. That is, there should be some escapement of taxes. Whereas here it is not there. For any purpose they can initiate an audit. So therefore, significant difference between 65 and 66. 66 is very, very specific. 65 is very, very broad. So these are all the points with respect to 65 and 66. There are other points as well which we will see. Time for completion. Okay, so there is no time limit at all for this particular audit. We will close this type 1 audit. There is nothing much to discuss in type 1 audit. Okay. So whereas 65 and 66, there is time limit. Let us divide this into section 65, and there are other few points which we will discuss. 66. Time limit for completion. Right. This is 3 months. 3 months from date of commencement. Okay, and extended to 6 months. And extendable to 6 months. So this audit, if it is initiated, it has to be completed within 3 months from the date of commencement, which can be further extended to 3 more months, that is 6 months. There is a definition for date of commencement under this section, which is slightly important because this is asked in objective type. Okay, so when I say date of commencement, is it the date on which I sent the notice? Is it the first date on which I go to his premise and start the audit, etc.? Will be the subject matter of discussion. So we will see what is date of commencement. Date of commencement is defined. Date of actual institution or audit, or date on which accounts called upon. So date of actual institution of audit, or date on which books records called for are provided. Records called for is provided. So please understand, this is very, very significant because time limit for completing this audit is very, very limited. It is only 3 months. But at what point in time this time is commenced? Date of commencement. From the date of commencement, it is 3 months. When can I say I have commenced the audit? Will be the discussion. I can say that audit has been commenced later of the following dates. One, date of actual institution of the audit. Obviously, I will conduct the audit by giving a notice. That date or date on which records called for is provided. Let us say in the notice, I am calling for a list of documents or list of information from the associate. Whenever you give the document, that date or date of me giving a notice for audit, whichever is later. So therefore, from that date only 3 months has to be calculated. It is not blindly 3 months. So therefore, date of institution of the audit or date of records called for, which is provided, whichever is later. Right? So therefore, this is the time limit for section 65 audit. Let us now come to section 66 audit. Okay. Again, similar to this, time limit for completion. Okay. 90 days, further extendable to 90 more days. So if you look at 3 months almost same. Here it is 3 months, here it is 90 days. There is no such thing called as date of commencement, etc. It is 90 days from the date of initiating the audit, which can be further extended to 90 more days. So therefore, time limit wise, section 65 and 65 are almost same. The last point here is remuneration will be paid by department and not the assessee. Okay, this point is not applicable to 65 and 35 pay. Remuneration, if any, has to be paid to the chartered accountant, will be paid to the department and not the assessee. So to summarize the entire discussion, there are three types of audits under the GST law. One is the turnover-based audit, section 65 is department audit, section 66 is a special audit. So as far as applicability is concerned, turnover has to exceed 2 crore rupee for 35 audit, whereas there is no applicability such as when it can be applied. Whereas in section 16, there are a lot of conditions to be satisfied. There has to be a scrutiny, investigation, or any proceeding. During the proceeding, there is an issue with respect to value of supply or input tax credit, and the issue is complex. Therefore, you can appoint a chartered accountant or cost accountant to audit this particular company. Next, who can conduct the audit? Obviously, commissioner or officer authorized by him. Here it is the chartered accountant or cost accountant who will be nominated by the commissioner. Whereas here it is chartered accountant or cost accountant. That is in the section 35(5). What is where the audit will be conducted? In the place of business of the SSC. Most of the place of business. What is the purpose? Section 65 is for any purpose. Section 35(5) there is no purpose. Moment aggregate turnover exceeds, you have to do it. Whereas in case of section 66, the purpose is to safeguard the interest of the revenue. And the last one is time limit for completion. 65, the time limit for completion is 3 months from the date of commencement. What is date of commencement? Date of institution of audit, or date on which records are received by the department, whichever is later. Whereas in case of section 66 audit, it is 90 days, which is further extended to 90 days. In 66, there is one more point, which is remuneration. Remuneration will be paid to the department. So, with this, we are done with the audit. You can look at the what we call the material with respect to study material with respect to audit questions. And if you have any clarifications, you can come back. You can meet tomorrow at 7 a.m. Thank you. Have a good day.